Welcome to Phillip Capital Weekly Market Watch. I'm Lin Xin from Unit Trust Research. Today, we would like to share some thoughts on China's market and what to expect in near future. Overall, we are optimistic on China's economy on its improving fundamentals. According to the preliminary data from the National Bureau of Statistics, the world's largest economy expanded 7.4% on year in the first quarter of 2014. Despite that growth slowed to 18-month low from 7.7% in the final quarter last year, the better than expected data suggests stable growth of the Chinese economy in the beginning of year 2014. Both Official Purchasing Managers Index (PMIs) are in expansion territory, though both moderated, but this is a good sign as China rotates to a more sustainable growth engine driven by domestic consumption. Another signal that shows the economy is on its course of rebalancing is the increase in spending on consumption against the country's GDP, which rose 1.1 percentage points to 64.9% in the first quarter, as compared to the same period last year. Retail sales grew 12.2% on year in March, and we expect retail sales to continue to grow on the back of increasing purchasing power. 2014 growth target is set at around 7.5% and is deemed flexible. Policy will focus towards reforms and rebalancing the economy rather than growth, but also to support stable employment and, at the same time, provide support to investors' confidence that reforms will be implemented in a stable growth environment. On April 2nd, China has rolled out a mini stimulus package worth 500 billion yuan to boost growth. On April 23rd, China's government has moved ahead to allow private capital investment in projects, or in sectors that were previously dominated by state-owned enterprises. Another reform designed to spur the country's slowing economic growth. However, large stimulus like the one following the 2008 global financial crisis is unlikely. Premier Li has indicated that short-term and strong stimulus policies will be limited to prevent temporary fluctuations in the economy. Policy rate remains unchanged at 6% as the central bank maintains its proactive fiscal policy and prudent monetary policy stance. But policy is likely to be tighter than last year amid efforts to contain local government debt and control financial risks. Money supply growth slowed to 12.2% on year at the end of March, which is within the official forecast range of around 13%. Inflation CPI rose to 2.4% year-on-year in March, which is still within the full-year inflation target of 3.5%. This will provide plenty headroom for policymakers to maneuver. Both exports and imports were down in March, indicating a moderate internal and external demand. But the trade balance reversed to a surplus in March, erasing some concern after a deficit in the previous month. We expect China's trade to pick up amid improving overseas prospects, especially economies of China's major trading partners, namely US and Europe, alongside the weakened yuan. China has widened its renminbi's daily trading band to plus or minus 2%, and this will lead to a higher volatility in medium term as China moves towards liberalizing its exchange policy. It was devalued on the back of weaker exports data, but it was expected to be temporary. Current account surplus, large foreign exchange reserves, net FDI inflows, and as a net creditor position to the rest of the world will provide fundamental support for the currency. However, key risks remain as the shadow banking industry and a sharp property market correction. In the recent NPC annual meeting, China has set a timetable concerning regulation over shadow banking, which shows that at least they are not in a state of debt denial. China will develop a regulated regional borrowing mechanism, while the authorities have already started a cleanup of the $6 trillion shadow banking industry and identified the sectors of the economy in need of consolidation. The recent landmark domestic bond default, the first onshore bond default by Shanghai Chaori Solar Energy Science and Technology Company, also signals Beijing's willingness, albeit tentative, to let some weak companies fall. At the same time, fixing overcapacity is once again made a priority. We expect the level of restructuring and defaults to accelerate as companies sell assets and undertake mergers in a bid to pay their debts in coming years. Over time, weaker companies will drop off, winners remain in the market will be stronger and the market will be healthier. As for the local government debt concerns, it is not the size of the government debt but the growth rate of the debt that worries the investors. China's local government liabilities increased 67% over the 3 years. Generally, it is unsustainable for a country's local debt growth to continually outpace GDP growth. But in China's case, we have some mitigating factors. One, most of the debts are domestic in nature. That is, China is indebted to locals, and thus, credit risk is mostly confined to domestic market. Secondly, with their capital controls, in other words, a relatively closed capital account, creditors cannot take their money out of China without exchanging with other assets. Hence, a run is highly unlikely. As for the concerns on sharp property market correction, China's home price growth slowed for the third consecutive month to an 8-month low in March, amid tighter credit to rein in excessive borrowing and individual city measures to curb property prices. Average new home prices in China's 70 major cities rose 7.7% on year in March, moderating from the previous month's 8.7% growth. However, in China's most developed cities, demand is still strong and price growth remains stable. China has taken a stance that it will take a differential approach to regulate the housing market and curb speculation and investment-oriented purchases via a subsidized housing program. As for the stock market, Shanghai Composite is moving sideways as the Asia's largest economy shift gear. It's at historical low valuation, trading at below its long-term average, minus 1 standard deviation of PB ratio. China announced to allow cross-market stock investment between the long-depressed Shanghai market and Hong Kong stock markets. The cross-border equity trading will help the development of capital markets in both Shanghai and Hong Kong, and present few investment opportunities as a gateway for foreign investors to buy relatively cheap A-shares stocks and for China to attract foreign funds, as well as mainland investors to have better access to Hong Kong's capital market. We foresee that the dual-listed stock price spreads will narrow over time. As such, we are positive on the outlook of the China stock market as reforms is in progress, pro-growth stimulus package rollout, and corporate earnings are picking up momentum as earning growth estimates are trending higher. For a quick recap, 1. Reforms and rebalancing are pulling back growth rate, but growth rate remains compelling at above 7%, supported by positive macro fundamentals. 2. Optimism that new stimulus measures will help the economy to reach its 2014 target growth rate of 7.5%. 3. Shadow banking system that fuels credit markets and real estate bubble remain the key risk, but we take comfort that the government is taking steps to get ahead of the situation. 4. Shanghai Composite sees a consensus earning forecast growth of 26% year-on-year, which translates to a 8.23 times PE. Hence, with earnings growth is picking up and valuations are low, coupled with improving macro fundamentals, we upgrade China to a neutral weight from underweight. So, for investors who are seeking opportunities in big market, but suffering from the US, Japan, Eurozone fatigue as their markets are long stretched, could consider investing in China. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Lin Sin from Phillip Unit Trust. Tune in for more Market Watch videos.